easy to set. We have to set policy, though. So that's what we're doing. And, so to look at your question this way, I don't think that we're behind the curve. I actually believe that policy is well positioned to address the range of plausible outcomes. And that's what we need to do. I do think it would be premature to raise rates today. That's not, I don't think that's controversial. Certainly, I don't know anyone arguing for that today. And the reason is that there's still ground to cover to get to maximum employment. And we don't want to stop that when there's good reason to think. There's still good reason to think, although it's been delayed, clearly, there's good reason to think that the economy will reopen, particularly if we do get past, significant outbreaks of COVID. That's when we're really going to see what the characteristics of the labor market are. And, I think, the bottlenecks that we're seeing in global supply chains around goods, and frankly now at our own domestic ports, because demand is stronger than the capacity of those ports, those things are going to work themselves out. We have a flexible economy. It'll take some time, but, it took the experts managed to create a vaccine faster than certainly than I expected. And I think this stuff will work itself out over the course of next year. That is my baseline understanding, and that's very widely held among people. But we are prepared for different eventualities, and we will use our tools to achieve price stability and maximum employment. And we're going to let the data lead us to where we need to go. Our policy will adapt, and has already adapted to the changing understanding of inflation and of bottlenecks and the whole supply side story, which is also partly a demand story. So our policy will continue to adapt as is appropriate.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking our questions. So you announced that the Fed is going to taper at a rate of starting at $15 billion a month, and that's more than twice the pace of the last taper. So why are you tapering faster this time?
The economy is in quite a different place than when we tapered back in, I guess it was 2013. We were much farther away from maximum employment. Inflation was much lower. This is an economy where demand is very, very strong, and job openings substantially exceed the number of unemployed people. So the need for further stimulus is far less than it was in 2013, where we still had quite a ways to go. I mean, after we began that taper, it was still many years before we reached what I would characterize as conditions consistent with maximum employment, let alone price stability. So this is quite a different situation, and the committee unanimously felt today that we had met the test that we'd articulated, and this was appropriate. And this is faster than what people had expected 6 months ago. It's earlier and faster, and that's because as I mentioned, our policy has been adapting to the situation as it evolves, as it's clarifying itself, and that's partly because we see inflation coming in higher. So,
thank you. Let's go to Mike Derby.
Supply chain and printing of money.
Thank you for taking my question. I wonder if the Fed has
along with
given any
unemployment
thoughts yet to the
leads to
endgame for the
hyperinflation.
Balance sheet in terms of, once you get the taper process complete, will you hold the balance sheet steady, or will you allow it to start passively winding down? And then in a related question, do you have any greater insight into what Fed bond buying actually does for the economy in terms of its economic impact? Have you been able to, measure it or quantify it in any fashion? Because I'm sure there's often been questions about what is bond buying actually doing to help the economy?
Sure. So in terms of the balance sheet, those questions that you mentioned, we haven't gone back to them. Now that we've tapered, I expect that that's exactly what we'll do in coming meetings, and we'll do it in an orderly fashion. And we'll talk about reinvestment and all those things.
Everybody else lose audio?
And we don't have to make decisions on those yet. But typically when we're doing a new subject like that, we'll have a series of briefings and discussions, and that's what we will now begin to do. In terms of the effect of asset purchases on the economy, so there's a tremendous amount of research and scholarship on this, and you can you can find different people coming out with different views, but I would say the most mainstream view would be that you're at the effective lower bound So how do you affect longer term rates? There are two ways. One, so you can't lower rates. Let's say you can't lower rates any further, hypothetically. So you can give forward guidance. You can say we're going to keep the rates low for a period of time, either a specific period until certain conditions are met. The markets will do the math, and that'll have an effect on longer-term borrowings, even 10, 30 years out kind of thing. So that's one thing. The other thing you can do is you just go buy those securities, buy longer-term securities. That will drive down longer-term rates.
Just
and
spend
hold
more
them
money.
lower. And rates
money
right
at the
across the rate spectrum matter for borrowers. So lower rates encourage more borrowing, encourage more economic activity. People that you can service your debt, you have more free cash flow. It's not different from what we do at the short end. So that was discussed long before anybody did it. That was, I think, Milton Friedman said that was what you could do if you were pinned at the lower bound many years ago. So anyway, that's how it's supposed to work. And it's quite hard to be precise about these things because you only have one economy and you can't run two different economies right next to each other and do a scientific experiment. But most of the findings are that it does support economic activity in the way that you would expect, which is to say, at the margin, more economic activity with lower rates, which is why we do what we do. More accommodative financial conditions lead to more economic activity over time with a lag. So I think that's the main finding I would say on QE.
Thank you.
Thank you. We're going to go to Paul LaMonica at CNN.
They're not raising interest rates.
Chair Powell,
as of now.
Powell, you've addressed already questions about the
Correct, JH. The
stock
economy cannot
purchases
afford
that took
to print more
place
money.
from some of the regional Fed presidents, and addressing the American people to make sure that they can trust the Fed. I was wondering also, in light of the fact that we now have questions about your own future, whether or not President Biden will nominate you for a second term, what would you say to the president and to senators that potentially will be voting on a renomination about this specifically with regards to your future as Fed chair for a possible second term?
Elizabeth Warren.
I won't have any.
Want him
I
out.
will answer your question, Paul, but I'm not going to have any comment whatsoever on the renomination process at all. I will say, though, that I have briefed administration officials and I've briefed people on Capitol Hill in detail about what we did and why we did it, and seeking their feedback, getting their reaction. But this is part of my job. Congress has oversight over the Fed, and we take that very seriously. So if you're on our one of the two committees that has oversight over us, then I'm in regular contact with you probably. And when something like this comes up, I'm on the phone. I'm offering to meet with you and explain it to you and answer your questions and identify any concerns people might have. That's just part of my job. So I do that. I don't talk about particular conversations, but you can assume I'll always do that, and I certainly did it in this case.
Thank you.
Thank you. Let's go to Hannah Lang at the American Banker.
Hi, I wanted to ask about the supplementary leverage ratio. Is the Fed still planning on seeking comment on ways to permanently adjust that? And how concerned are you ultimately about banks' willingness to intermediate in the Treasury markets without a permanent fix?
So I don't have anything for you on supplemental leverage ratio right now. We are looking at ways to, if there are ways we can address liquidity issues through that channel. We also have there's a working group headed by Treasury about over Treasury markets and what happened in the acute phase of the pandemic and what structural things may need to be done. So that would be part of that work stream. And I know that there's a lot going on. I'm not sure when that report will be out, but so it's work underway. That's one of the many issues that are part of that, along with things like central clearing of treasuries, greater central clearing, and many other ideas. It's important that we have a liquid treasury market. It's a huge public benefit that we do, and I think we need to do those things that enable that, while also assuring safety and soundness of our largest financial institutions, who tend to be the main dealers. So we have to make sure that's always a first order concern as well.
Thank you.
Thank you. Let's go to Brian Chung at Yahoo Finance.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. So just to expand on the ethics conversation, you talked about how you engaged with people on Capitol Hill and in the administration. You talked about what you've done already, but I'm just wondering if you could take a step back and just assess whether or not there was reputational damage as a result of that, either from the public's view or from the financial community's view of the Federal Reserve's independence. And then secondly, do you look back on the whole episode and have thoughts on your individual responsibility in preventing something like this from having happened?
So I think it's too soon to say what the reputational damage is. I think from the very beginning, my reaction was we need to deal with this straightforwardly, transparently, and forcefully, and that's what we're going to do. I mean, it means everything to me that we do whatever it takes to make sure that nothing like this happens again. And I like to think we've made a real good start on that. If you think about it, you cannot execute a trade unless it's pre-cleared. And then you have to say execute. It's not even a trade. Really, there's no trading going on. This is for investment and getting liquidity for life's expenses. But you then have to wait 45 days to actually execute that sale or purchase. So I think it's a pretty good system. We'll always be looking to make it better. So in terms of our independence, Look, I think we will address this, and I think we have, and I like to think it's enough, but it's going to, we're just beginning to implement it. We have to write the rules, which we're doing, as quickly as possible. We need more people. We're going to have to resource this much more significantly here at the board, and also we're going to need appropriate technology because, the Fed system has more than 30,000 employees. Not all of them. Far fewer of them will be covered by this, but the senior officers who will be covered by this will have to have technology access, and it's going to have to work efficiently. So there's a lot of work to do to implement it. Again, I would just say this system has been in place for decades, and it was in place when I took over. It was in place for at least the last 3 or 4 chairs, and it was what it was, and it proved to have weaknesses in it. And part of that was that it wasn't uniformly enforced across the system. I'm a big believer in the value of the Federal Reserve System and the reserve banks, but you had 12 different ethics officers at 12 different banks, and you had ethics people here, and compliance wasn't all exactly the same. It was a little bit different and uneven. And also the rules were, we didn't imagine the problems that happened, and they may have actually been, I don't know this, but they may actually have been in compliance with the specifics of our rules. They were clearly not in compliance with the part of our rules that said don't do anything that would create a bad appearance. I mean, that's clear. This was a bad appearance. So anyway, what can we do? We are where we are. It happened. And we just have to deal with it forthrightly and transparency and own it and step up to this, meet this moment. I'm totally committed to doing that. And again, if there are better ideas, I'd love to hear them. But I think we have so far made a good start.
When you say you spoke with administration officials, did that include the president?
I'm not going to answer who I spoke to at all. I'm not going to give you any names, so don't take that as a yes or no. I'm just not going to start down that road.
Okay, thank you. We're going to go to Jeff Cox for the last question.
Yeah, thank you. Chair, I just want to dig a little bit deeper on employment. We've seen what's been called the Great Resignation, with folks leaving their jobs in record numbers. Is there any feeling there that maybe you've been accused of fighting the last war, that perhaps the labor dynamics have changed in the post-COVID environment, and that full employment may not look like what it looked like before?
Yeah, so what's happening is people are leaving their jobs. They're quitting their jobs in all-time high numbers, but in many cases going back into employment and getting higher wages. So a lot of the higher wages you're seeing are for job switchers rather than incumbents. So that's a sign of a really strong labor market, as opposed to people just running off and quitting. There are a significant number of retirements, and we'll just have to see what that means. So toward the end of the last cycle, which was the longest in our recorded economic history, we did see labor force participation moving up well above what economists estimate was the trend. And part of that was people staying in the labor force older and just not retiring at the rates they were expected to retire. So maybe this was just catch up on that. I am a believer that over time, you won't know how far, you won't know what can happen with labor force participation in advance, and you're just going to have to give it some time, because we saw that over and over again. There are things that we can say, this is where the limit is. Labor force participation is a much more flexible subject for me, and so I do think we need to be humble about what the limits are of labor force participation. But we expect labor force participation to pick up. We don't know the pace at which it will do so. So in terms of full employment, as I discussed earlier, I think at the very beginning of the recovery, the natural thing to do was to look back at labor market conditions in February of 2010 at the end of the longest expansion in our history. It was so much to like about that labor market, really historically good labor market, never perfect, but a good labor market. We're in a different world now. It's just very different. The pandemic recession was the deepest, and the recovery has been the fastest. And wages didn't really go down, and real incomes were more than fully replaced by fiscal policy. All of this is completely unusual. An economy where inflation was driven by services is now inflation where all the inflation is in goods, which have had negative inflation for a quarter century. So you ask about full employment, I think we have to, I'm very open to the thought that it's going to be an empirical question of where it is located. And we're just going to learn more and more. I mean, one thing we'll learn, I hope we'll learn in the near term, is once the Delta variant really does continue to decline, what's going to happen to employment? Are we going to start to see over the winter, significant increases in jobs again? If you look back, the 3, 6, and 9-month average job creation is between 550,000 and 600,000. So if you think of that as a stronger, you don't have to think back to the million job months of June and July. You can just think, okay, 550 to 600. If we should get back on that path, then we would be making good progress. And we'd like to see that, of course. So we'll know so much more, and believe me, we understand it's a different world in so many ways, and we're very open to that.
Thank you, Mr. Chair, and thank you all for joining us
Thank
today.
you.
You don't know what the fuck's going on. You don't know what's going on and what's happening next. Powell clearly stated earlier that the supply chain issues that we're currently having, combined with the artificial printing of money, the number of people that are not employed due to various reasons, such as the vaccine mandate and quitting their jobs for other issues, we're not looking at getting rid of inflation. Inflation is not transitory. It's here to stay for a while. It's not something that's going to be going away anytime soon. It's going to continue to increase, especially with the supply chain issues we have and the supply and demand things that are going on. My dog's being a weirdo. That's funny. But for those of you that aren't aware, 58% of Americans, 58.4% to be exact, are employed. That's not a number made up by Trump. That's from the Bureau of Labor Statistics. That's pretty shitty overall. Everybody between the age of 16 and 75, we should be looking at somewhere in the 62 to 64 range minimum. So for that to be occurring right now is really bad for the economy. And the Federal Reserve announced that they're not going to be raising interest rates immediately. But they are going to begin tapering on November 15th. Look at what he says. Yes, what is happening is people are leaving their jobs. They're quitting jobs in all-time high numbers, but in many cases going back into employment and getting higher wages. However, that's not the case, because just because these people are not applying for unemployment, it doesn't necessarily mean that they're employed. Granted, sure, plenty of people are moving on to new, bigger, and better things. A lot of the higher wages you're seeing are for job switchers rather than incumbents. That is a sign of a strong labor market as opposed to people just running off and quitting. And I do have to disagree with him on that fact, because he tells us that people are just running off and quitting, are not just doing that. But I just don't see that happening, because we're still seeing an increase in the number of new jobs and in the jobs reports. And it's not as strong as it should be, even still. So yeah, Jerome Powell needs to get the motherfucking money printer out. But it's unfortunately not even going to make a difference at this point, because if he prints more money, or if the United States prints more money, they will not be able to curb inflation, because the supply chain issues are not getting items on the shelves fast enough. So even though people have money, they won't be able to buy it. The price will continue to rise up. Glizzy says it'll be a theta decay for the middle class. Yes, the theta decay will be serious. As you've seen, like the minimum wages has gone up in many areas. For example, here in Chicago, I think it's $15 an hour now. And unfortunately now there's certified nurses assistants and other people that are only getting paid $16 or $17 an hour, while people working at McDonald's are getting the same amount. I hate to say it, even Kevin T here says, "I quit my job, tired of crappy bosses." That's the truth, though. Often is what we're faced with is more so than just a crappy job. It's the leadership and the companies that are heading all this. This is some interesting, scary times. In case you guys are unaware of the Shiller PE ratio, it's the cyclically adjusted price earnings ratio created by Robert Shiller, and it is up over half a percentage point today alone. It is currently sitting at 39.64. Anyways, the higher this number is, the more overvalued and oversold our stock market is. The only time it's been higher was the 2000 dot-com bubble. Right? You saw here in 2000, it was extremely high. We had a huge market crash, and it brought the price to earnings ratio into a much better percentage when adjusted for inflation. That's what's important about the Shiller PE, is that it takes inflation into account. And the same thing you saw here in 2008 after the market crash, and 1929 Black Tuesday market crash. It was a massive correction. You can also pull it up for the S&P 500 because it works extremely well for indices. Yeah. Again, the S&P 500 price earnings ratio is fairly overvalued. It was only previously beat by the 2020, 2008, and 2000 crashes. Those dot-com bubbles and the real estate and derivatives issues that we had with collateralized debt obligations in 2008, here, this is where we were at the top, up in the 65s, and it was a severe dip. The problem is that now all those mortgage-backed securities have just been moved around into different tranches of garbage and pushed around further. So they're still trading the same things times 10, basically. This is the inflation-adjusted S&P 500. We're extremely oversold. We've hit all-time highs 63 times this year, and that's only happened 3 times in history. The last time it happened was in 2019, before the market crashed. And before that, it was the dot-com bubble in 2000. And prior to that, the only time we've had all-time highs, 60 new all-time highs, in 1 year was 1969. Right here. Here, and now here we are. But this one, unfortunately, is going to be much worse because in 2000, during the dot-com bubble, Congress was arguing about a $33 trillion in derivatives. Now banks have $426 trillion in derivatives. What do you think that means? It means the mother of all short squeezes is fucking upon us. That's what I think it means. I think it's coming. It's coming extremely quickly. I think we're going to be fucking rich. This market can't keep up with this, unfortunately. And what people don't understand is when I say that the stock market being overvalued and the, oh shit, you can't even see the 10-year Treasury rate on the screen because it's so low. The Treasury rates being so low, such as the 10-year being at 1.56. The reason that this is bad for the majority of stocks and good for heavily shorted stocks is because the majority of stocks, blue chips, are going to be sold off. And then all of those heavily shorted stocks, in order to maintain margin requirements through these junior hedge funds and banks that all own them and have shorted them, they have to be purchased back. Short positions have to be closed out, so they have to buy to close, literally. And when they buy to close, during a margin call, or should I say a margin default, the computer nor the DTC gives a shit what the price is. Buying back will occur until they reach an acceptable margin position again. So, that being said, I think we're all going to be filthy fucking rich. I feel bad for the majority of Americans that are not properly invested for this, but there's nothing I can do. You know, I'm not a financial advisor, and nobody really knows what's going to happen. So do your own due diligence. I think that we've looked into this quite a lot so far in the past, so I won't delve too deeply into this. But for those people that don't understand, a market crash will cause the majority of stocks to go down, and the minority of stocks that were heavily shorted, such as GameStop and AMC, as well as other things that run inverse to the market, such as the VIX, to fucking skyrocket. I want my fucking money. We're gonna be fucking rich. Holy shit. Peace and wealth. Thank you guys for your support.
You know what the negative vote is?
I want my fucking money. Gary Gensler.